Hi, this is Aron Benjamin back again with Legally Speaking. This month we talked to Mike Goldberg in our tax department. It is tax season, so we went over as much as we could in the 30 minutes that we're going to show you. We actually had a lot of information that we're putting out later on this year as well. But for this episode, we talked about individual taxes, business taxes, and not just what to do for this year's taxes, but how to prepare for next year. We also talked about the Inflation Reduction Act and a couple of other things I think you might find interesting. I hope you enjoy. With Aaron's hair or anything, you know, we'll blame it on that.
That makes sense. The hair had to have been the technology.
Welcome, I'm Aron Benjamin. Thank you for joining us here on Legally Speaking. I'm here with my friend Mike Goldberg, who's with our tax group here at Stein Sperling. Mike does just about everything. He's a jack of all trades. He specializes in tax controversy, both individuals, corporate entities, partnerships, and anything can't think of. I'm sure he'll enlighten us soon. Welcome, Mike. Thank you for coming on.
Thanks, Aron. Long time listener to the program, so excited to be on.
Great. So this is, as we call, or you call them, the business tax season. Is that right?
It is. April 15th.
So I appreciate you taking the time to speak with us because I know you're very busy right now. And I think some of the topics that you're dealing with in real time are going to be helpful for our viewers and listeners to hear about. And I kind of want to start at an individual level and then expand it out to corporate or non-corporate entities, and then get into kind of the controversy stuff, which I think is, at least, you know, as a bystander, knock on wood, bystander, an interesting, if not gut-wrenching side of tax law. Is it safe for me to assume that if you're just now starting to think about your 2022 taxes, you might be on a little bit behind the ball?
I would say so, yeah. A lot of the big issue in the accounting community right now is that there's not enough accountants. And so a lot of them, if you're thinking about it now, you're probably going to be put an extension to the end of the year. And one of the most important things I always tell my clients about an extension is an extension to file, but not an extension to pay your taxes. So it makes it a little bit tough because if you owe tax, it is due on April 15th. Yeah, I mean, I would say the lesson with taxes always is it's best to start now, or maybe yesterday, but now.
Let's say I come to you, all right, and I say, Mike, I think I might be in a little bit of trouble with my individual taxes. What might be some of the things that would prompt a visit from someone like me or any individual who could have an issue with the IRS or with state taxing entities? You know, anything from maybe like employee bonuses or tax deductible receipts, foreign accounts, cryptocurrency. What are some of the hot spots that you're seeing right now?
Well, you listed a bunch of them, and one of them, yeah, I think I'll start with the bonuses. That's a big one that, you know, just kind of most people who are in this area particularly I see the biggest issue with is when they get bonuses that can start creating tax where they owe tax at the end of the year. I'd say maybe not an issue, but, you know, a surprise bill at the end of the year. Oh, well, I owe a good amount this year. And that's because of I guess when we get bonuses, we kind of think, oh, the government's taking so much of my bonus, I can't believe it. But actually, for most of our clients, they're actually not withholding enough. The average, the federal government only withholds they withhold 22% on your bonuses by default of your tax, which most people, I'm not sure. I mean, I don't want to put you on the spot, but what percent tax do you think you pay? But most people in this area, I'll say, I'm not gonna find out how much you make, but
Oh, I'm sweating. Okay.
most people who are getting big bonuses in this area, high cost of living area, Washington, D.C., 22% is not enough. For the tax brackets, if you're single, it's about 90,000 of income above that. If you're married filing jointly, double that, 180,000, around that amount. So when you're getting bonuses and you're making more than that, you're not having enough taken out of your paycheck.
What could somebody do outside of don't do as good a job so you don't get a bonus? What could someone do proactively that's positive to lessen that impact?
So first of all, a great way to pay less taxes is you make less money. It's a great way to do that. But yeah, when you're an employee, you kind of have less flexibility in terms of what you can do to try to lower your taxes. But we have some mechanisms as employees. You can give money to your 401k. When you give money to 401k, it's lowering the amount that you're taxed on. So each dollar you do that is lowering the amount of current taxes. Other kind of health plans, health saving accounts, flex spend accounts, giving money to those are going to be tax deductible, so you won't have as much income associated with them. And then also 529 plans help plan for your kids' education. Those expenses are going to reduce your taxes, or if you're self-employed or if you own your own business, you have a little bit more flexibility, and there's a lot more planning that can go into that than if you're a W-2 employee.
So we talked about what's clearly on most people's mind. Are you going to owe money? And the broad factors that impact a lot of people. Bonuses, 401ks, 529s, retirement plans, that kind of stuff. Let's talk a little bit about, on the individual side, some of the murkier waters, some of the things that are either new or a little bit confusing for people. I'm talking about cryptocurrency. I'm talking about foreign investments, how to handle household employees.
I think most people, when they get at the end of the year, they're putting together their tax documents. I got my W-2, I have my 1099, I have my mortgage statement, all that stuff. But it's important to note in the U.S. that we have a voluntary tax system. I know everyone feels that way. But
very voluntary.
Completely voluntary. But as part of that,
you need to report. The IRS says you have to report all your worldwide income. Actually, Congress says that. And it gets much harder when you have foreign accounts and you have cryptocurrency, for example, because we don't have good reporting for those items. You don't get sent a statement from the way when you do stock transactions, Fidelity or whoever your broker is, will send you a statement at the end of the year. You made these trades, you had this many dividends. So cryptocurrency gets really difficult. In particular, you start with cryptocurrency because particularly I have many clients that are using computer programs that are executing hundreds, thousands of trades a day. And so it gets very difficult to report all that information. It all is reportable. Even if you didn't make money, that's another part. Some people say, I didn't make money, I didn't think I need to report it. That's not how our system works. Unfortunately, you have to report all those trades, and then you may get a slight tax benefit for it, but you probably are going to pay more in professional fees to put that together, unfortunately. But cryptocurrency in particular is an area, the way that foreign accounts were a couple of years ago, is an area of emphasis for the IRS. You'll notice if you look at the Form 1040, the form everyone files, all individuals file, right below your name and address, the next question is about your digital assets. Did you have any cryptocurrency trades basically during the year? Did you buy or sell? And so it's really like the IRS is making no qualms about it. This is a point of emphasis for us. Cryptocurrency is treated very much like stock, basically. There's some exceptions to that, but kind of like stock. So you get taxed based on when you sell it. When you buy cryptocurrency, there's no tax on that. When you if you have one Bitcoin and you transfer it from your Coinbase account to your private wallet, that's not a taxable transaction. It's only a taxable transaction when you actually sell cryptocurrency. And included in that, which I think is difficult for a lot of people, is if you convert, for example, Bitcoin into another coin, that's a taxable transaction. Those are hard to calculate too, because it's all based in what's the US dollar amount for each of these. But at the basic level, you have to report the difference between what you paid for the cryptocurrency as compared to what you sold it for. Foreign accounts are a little bit different than cryptocurrency because we do have information sharing with other countries. So if you have accounts in the UK, for example, the United States is getting information on them, but you may not be getting tax forms that say, hey, this is what happened during the year, that makes it easy for you, for your account. It's a lot more legwork to have cryptocurrency accounts, to have foreign accounts, but those are both very important parts of the tax preparation process for people in the US.
One last question on crypto, and then we can move on. It's a currency, and currencies are used to buy goods or exchange for services. And right now we're talking about purchasing crypto, the currency itself, and taking, whether, like you said, mining, whether you're taking a loss on it or you're trying to increase your portfolio or your wallet. But how is it tracked when you use the currency to buy something? And we all heard of NFTs, but there's products and services you can buy with crypto. How's that treated by the IRS?
While people might use it like currency, the federal government, to protect the US dollar, they don't let you treat it like currency exactly. It's treated more like an asset. So it's basically the exact same as if you bought a piece of gold and then traded that piece of gold for a book. So it's treated as if you sold the bar of gold, and so you got to figure out compare how much you bought the gold for versus how much you sold it for, and then now that's your new basis in the book. So it's a taxable transaction. We give some deference to foreign countries. So if you go to Europe and you're using the euro, if it's under a certain threshold, you don't have to worry about it. Like, because obviously the euro fluctuates as compared to the US dollar, kind of the same as Bitcoin. So it has a little bit of a benefit that we give a preferential status to other currencies that are kind of officially recognized by the European Union or whatever country. But we don't do the same thing for cryptocurrency right now. We make it as difficult as possible to use. But to use Bitcoin every day to buy everything that you do would be a tax nightmare, I would say. Yeah.
Switching gears here a little bit, more towards employer side, business entities. Let's start out a little small. With self-employed individuals, whether they're it's a one-person shop or they're a contractor. Give us a little bit of what you look for, or what you see as kind of the common pitfalls for someone who's self-employed or has a small company that they're dealing with.
The number one pitfall I think I see for someone who's self-employed is not separating out your business and your personal expenses. That really, really creates an accounting nightmare later on, just for you, for whoever has to go in and do it. Because a lot of times when you have you're saying, oh, I gave all my bank statements, but well, what if you're made a purchase at Amazon? Your statement says Amazon. Was this the diapers, or was this supplies for your office? And so that's, even if it doesn't get you in trouble, it makes your life a lot easier if the IRS comes knocking. But even if the IRS doesn't come knocking, just for keeping track of your own records, figuring out, well, how much did I make? And I think you're either going to be over-inclusive, you're going to take too many deductions, or you're going to miss out on some deductions if you do it that way.
What would be the red flags in your mind that might pop up and make one of the 87,000 new IRS agents or whatever it is that we might might have, and I know you're going to get into that a little bit later, but what if you had to guess, what are the red flags they're looking for, besides, or maybe including crossing accounts like that?
Well, I mean, so the IRS does have a kind of they have a system for how they determine whether they audit your tax return or not. And one of the things that they're looking at is when you have a business, you enter your business code on the tax return. So you say that I'm in legal services, for example. They're going to take all the businesses in your area that do legal services and kind of compare and accumulate, well, what percentage of your revenue goes to expenses and to certain expenses, to how much to wages, how much to rent, how much to employee benefits, how much to insurance, et cetera, whatever expenses you happen to have. So they develop a scoring system based on those types of things that they look at. But the biggest expenses that kind of have an extra layer of scrutiny with the IRS are automobile expenses, and then meals and entertainment. Those are kind of the two areas that there are a few others, but those are kind of the big ones that I see a lot of my clients get extra scrutiny on. And the law says that as well, those are areas of extra scrutiny. But yeah, I think it's always, technically you're supposed to keep a mileage log, for example, when you drive for business. And a lot of people don't do that in the real world. But I think it's also important that the number that you pick for that is unreasonable, or is reasonable. I'm sorry. I've seen, I was doing an audit early in my career, and the person, in terms of the mileage that they claimed that they drove, was something like they were driving like 7,000 miles a day to get, if you calculate the numbers. So that would be a lot of driving, I would say.
So try not to be an outlier, and if you do, have a good reason why.
Yeah, exactly. That is just kind of practically how the IRS looks at it. Is, hey, this is what people are spending in your industry, and your numbers are way out of line with it. That will increase your likelihood of getting audited. The entity choice matters too. I mean, the IRS releases guidance on, well, not guidance, actually statistics on who do we audit, and people who are sole proprietors, who it's just them in business, they get audited the most, particularly if you make more than $1 million a year.
Like, no matter how hard they're going to try and change those numbers and make it a little less predictable, there are some underlying factors there. High earners, I would figure a sole proprietor is probably going to be using their automobile and having meals during company time more often. So it seems inextricably linked between what they're looking for and those people who have small businesses or work out of their home or have 1, 2, 3 person shops. Is that accurate to think?
Yeah, that's not accurate.
We talked last month with Darla McClure about some of the new laws around businesses, especially small businesses. And as anyone who's been paying attention to the news has recently learned, there's, not recently, it's been in the news for about 1.5 years, there's been some fluctuation in our economy. There's been a change, in terms of profits and loss for businesses across the board. Employees are not necessarily in the workplace now. Now they're working from home, and that creates additional expenses and other things to keep in mind when filing your corporate taxes. And then we have an aging workforce. People are retiring, closing up shop, or trying to build transition succession planning for their businesses. In your mind, and I know I just threw a lot at you right now, from a tax perspective, are these things to worry about?
I think it needs to be a priority moving forward. All those things, they're all really material to your tax situation. Particularly, one of the ones you mentioned was having remote employees now. That's a big part of a change that obviously the pandemic accelerated, where now it's okay if we have employees in, we were concentrated in this one state, and now we have employees all across the country. And a lot of states had special rules in place that kind of, let's keep the status quo while we are in the state of emergency with the pandemic. And the pandemic really accelerated all this stuff, obviously, many of the things that you mentioned. But it's a really important time, I think, to check in with a tax attorney, with your CPA, about how to handle this situation, because you may now have tax exposure to where your employees moved to.
Good news for businesses.
Yeah.
I've heard of the employee retention credit. And if I've heard about it, then it's trickled down to the lesser intelligent individuals in our society. So for someone like you who deals with it on an everyday basis, how does that work? Is it something that in your experience is making an impact for business owners? Walk us through a little bit of how it's treated and the impact it's having.
The employee retention credit is really like one of the hottest topics in the tax community right now, and it's a split one, because I saw, for example, the other day I saw Kevin O'Leary from Shark Tank talking about it on TV, what an opportunity it is for businesses, and it can be an opportunity, but it's because it's the federal government. The federal government, basically, taking a step back, the federal government can give you up to $26,000 per employee based on 2020 and 2021, your business's condition during that time. But it's very important that because there's so much money out there, there's a lot of unscrupulous actors. And as a result, the IRS, I think a couple of days ago, just released its Dirty Dozen, which is kind of its 12 biggest tax scams, it thinks, or issues, it thinks, for the coming year. And the employee retention credit is on there. But it is particularly if your business struggled in 2020 and 2021, either you had a reduction of gross receipts compared to 2019, up to, there's a test for that, but so you want to make sure you're talking to a qualified person about it. That's one way. Or you were partially or fully shut down due to a government order in 2020 or 2021. Those are the two tests that they're looking at. But there's a lot of unscrupulous actors out there, and that's been a big area. So I definitely would encourage people, if you're going to pursue it, and I think businesses really should pursue it and find out if it applies to them, because a lot of businesses do meet that, particularly in areas with more stringent government orders. So California kind of being the highest, most stringent. In the DC area, we did have relatively stringent government orders as well. And so a lot of businesses were affected by that, and they may qualify as partially shut down. But I guess I can kind of see it's a nuanced area, and it's not as straightforward. So you want to be careful that when you're pursuing it, you're doing it through a reputable source, because it's a big area for fraud, but it is a really great opportunity for people who were negatively impacted by the pandemic.
So you're talking about penalties, and that's the next area we're getting into, because that's the hair standing on the back of your neck part of taxes. What happens if you owe money? What are some of the things you can do right now, or what are some of the questions someone like me can ask someone like you in order to figure out how bad is it and what can I do to mitigate this problem?
The good thing about, the IRS in particular is actually quite forgiving when it comes to owing money to the IRS, because I think, so they put out statistics, how many people are compliant, whatever, in their definition, but about 87% of people file and pay their taxes on time is what the statistics they have. But that means that 13%, which is, we're talking about millions of people, don't do that. And so they have a lot of they have really a lot of systems in place to make it so that if you owe amount that you need to pay, but it's a little bit more than you can pay right now, they have a lot of systems in place to let you do that kind of easily, straightforward. You can, if that's your situation, you owe, I'm just going to throw it around. If you owe $10,000, but that's more than I can pay right now. You can go online, you can create a payment plan easily, and you don't have to do anything too crazy to do that.
But I think number one is figure out what you owe. If it's just the most recent year in particular, try to address it now.
What are some of the tools that the IRS has in their toolbox to force compliance for people, that 13% that aren't getting it done when the IRS requires you to get it done?
Mm-hmm. Yeah, the IRS is a very powerful creditor. They have a lot of abilities to go after you. So the two main ones that we see most frequently are they can file what's called a notice of federal tax lien. So it's a public record out there that you owe tax. Number two, which is more invasive, they can do a levy, a garnishment, so they can go in, take money from your bank account. They can go after they can take a percentage of your salary. Two biggest, I think probably the number one thing that gets people to come to us though is Maryland, the states, they have the ability to stop you from renewing your driver's license, stop you from being able to renew your vehicle registration. Those are real big sticks. I mean, even sometimes, those other ones are really invasive also, but those are the ones that really start impacting your way of life. And Maryland, professional licenses too, the states have. The IRS said this is a great idea. They're getting all these people, the states are getting all these people, so Congress allowed them to go after your passport. So same thing, the IRS can stop you from renewing your passport. Technically, they can also not allow you to travel.
The Inflation Reduction Act covered a number of different areas and impacted a number of different federal agencies, but it had a very specific impact on the IRS and the tax-paying community. What was that, and how are you dealing with it?
Yeah, so the first thing was when it first came out, everyone had said, there's going to be 87,000. I think you talked about it before, but 87,000 new IRS agents all carrying guns to come to your door and arrest you. So that part is not necessarily true, but the IRS had been getting decreased funding for many, many years. And so this is going to allow them to reinvigorate their workforce a bit. Part of the story that's not told is that the IRS has about 50,000 employees who are set to retire in the next 10 years. And the 87,000 are going to be hired over the next 10-year period, so it's not going to be immediate. Part of it, there is some truth, I guess, to that phrase, because a good portion of that money is going to go to enforcement. Mm-hmm. It's supposed to be specifically for people who are making more than $400,000 a year, so quote unquote high income individuals. I think it'll be interesting in practice to see how they're able to do that easily. It's more of restoring the IRS to try to get them back to have the resources that they once had, as opposed to making some golden age of IRS enforcement, putting everyone in behind bars.
I guess that's why it's a 10-year plan, right?
Yeah. So we'll see what happens in 10 years, how far we are into that 10-year plan.
That's right. You'll finally have some gray, and whatever I have up here is going to be gone. So we'll talk about it then.
I guess the camera's not as crisp as it can be, because there's coming on the sides.
Well, then keep it fuzzy, Mike. That's the goal here. Well, thank you for joining us. This has been fantastic. This is kind of a fire hose of tax information, and you really laid it out nicely for us. So I really appreciate your time. Thank you.
My pleasure.